Recently, bond yields are rising, but broadly speaking, the returns that you can get from cash or bonds are still not particularly high. So, what is the outlook for such instruments? How can we better work our cash so that it returns us better than what it is in the current market situation? There are tools to explore, from cash management apps to trader endowment to high yield Asian bonds. We went around to discuss the different ideas and possibilities that one can participate in to maximize their value on cash. Welcome to another Chills with TFC session. In this series, we hope to bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape around the thinker. So in our pursuit of the life we love while managing our finances well, our guest for today is a couple that have built an interesting financial blog commenting on multi-asset investing with the fun retro gaming graphics. They both started their career in the financial space, analyzing REITs, stocks, and advising high net worth clients. So let's welcome Peter and Deborah from InvestQuest. For the sake of reference, this episode was recorded on 29th April 2021. You know, bond is not something that a lot of retail guys will talk about, right?
Oh my gosh, so few. What do you mean? It's like a really small minority.
Yeah, it's like really non-existent, right? So can you kind of give us a little bit of idea, like where do you see the bond market moving? And the general idea is like, interest rates so low, right? How to make money from this space?
So actually your question is actually a two-part question, right? Because bonds are actually impacted by two factors. Right, one is obviously the interest rate environment, but the second factor when you're investing in corporate bonds is also what is known as a credit spread, right? The compensation you're getting for investing into a risky asset, right? A riskless asset would be something like a Singapore government bond or a US government bond, whereas a corporate bond, even you invest in a government-linked company like let's say SIA or Keppel, you are still taking an element of corporate default risk, right? So maybe just to cover the first aspect, right, the interest rate environment, how is it looking like at the moment? So for the interest rate, most people just think of it as one number. It's actually a spectrum, right? There is short-term interest rates. There's also what is more known as longer-term interest rates or long-term yields, which can be proxied by stuff like your US 10-year Treasury bond, your 30-year Treasury bonds. So maybe I'll cover a bit on the short-term interest rate first. I'll let the longer-term yields be explained by Deborah a bit. So for the short-term interest rate, actually governments or central banks actually have a large say in influencing this short-term rate. So for example, if you look to the US, the central bank would be the Federal Reserve, right? And they are the one who sets what the Fed funds rate is. And currently they set it to 0 to 0.25%.
Yes.
Obviously to stimulate the economy. And if you look at what the expectation of when the next rate hike is going to be, actually the base case is in 2024 onwards.
Yes.
Which means that in the next few years, likely we're not going to see short-term interest rates going much higher, because even in the local market, we are quite influenced by rates set by other major economies like the US.
Of course, especially the US.
Yeah.
Yes.
So when it comes to our bank deposit rates, fixed deposit rates here, I think we'll still be hovering at where it's currently at in the next 1 to 2 years.
Same for mortgage.
Same.
So it's an extension of SIBOR,
yeah, so
right?
same as for mortgages.
Okay.
Likely.
So you're saying that short-term interest rates are very affected by what the government does, how they set, because they're essentially the referee of the market. They say it's like that, and every other bond will kind of reflect, reference to that kind of interest rates.
Yes.
Right, but they don't actually have direct control in the markets.
Yeah. So again, also it depends on country. So for example, in Singapore, actually MAS doesn't really set the interest rate, right? It's quite freely moving. But in certain countries, like the US, actually they do have a say like what the Fed funds rate is, right? So I think it really depends which country we're looking at. But given that Singapore is such an open kind of market economy, we are very impacted by what's going on around the world.
Okay. Then what about long-term?
So for long-term interest rates, they're expected to increase steadily as the global economy recovers. Now, when you're analyzing long-term interest rates, people tend to look at factors like expectations of economic growth, inflation, so on and so forth. So looking at these factors, they're all pointing towards higher long-term interest rates moving forward. So now summarizing what Peter has mentioned and I have just talked about. Analysts are expecting what is known as a steepening in the yield curve, where short-term interest rates remain anchored and long-term interest rates increase. Yeah.
So then, as retail investors, how do we capitalize in such a situation?
So for retail investors, actually, it's very tough now because for us, a lot of our emergency savings tends to be invested in obviously your traditional bank savings accounts, and more recently, there's also been the emergence of a lot of robo-advisors that have this what they call cash management accounts, or even a lot of the insurance, even Singtel Dash, gigantic Singlife account. These are all like insurance savings accounts that have recently come onto the scene to give local retail investors a slightly higher yield than what they're getting from bank accounts. But with the overall market interest, the short-term rates being so low, we've also been seeing across traditional banks and even on these cash management accounts, yields just generally have been quite suppressed. In fact, a lot of banks in the last 1-2 years, you would know they've been cutting your interest rates, right? 3 years ago, it was very easy for us to get, a 2-3% kind of return or interest rate on our savings account, as long as we did some criteria like salary crediting, paying a few bills, gyroing a few bills, or using the credit card from the bank. But today, if you want to get a 1% interest rate, it's really going to be very tough. Even
There's
for
a lot of asterisks in the 1% interest rate these days.
Correct. And even for the robo-advisors, we have seen a lot of them revising down their projected return rates to reflect this more realistic kind of return expectation moving forward.
Can you help us understand a little bit, like how do they derive these kind of returns?
So for robo-advisor cash management accounts, a lot of them are invested in a mix of money market kind of instruments. It's kind of short-term debt instruments. Some of them have short-term bonds also, right? And all of these are very heavily impacted by what the short-term yields are.
Yeah, essentially they're correlated with the short-term rates, right? Okay,
correct.
Okay. And then for some of these insurance companies, is it all the same? Are they all using money market funds or?
For the insurance companies, we can't really see what they're invested in. But just from my point of view, if you're an insurance company and you need to raise capital, right, you have a few methods you can do so. One, you can of course get money from these policy owners and give them their 1+%, or you could go to the capital markets, issue a bond and pay 3-4%. So for them right now, this could be potentially a very cheap way to get financing, right? Insurance companies are not the same as banks, because banks have a deposit base, right? They can just go out to depositors and they get this very, very cheap form of funding. So the best alternative for insurance companies is to issue this kind of savings, short-term savings accounts.
So it's a strategy to acquire more capital for them. Okay. And then so it's definitely affected, relative to the markets, right? Because they don't want to be overpricing themselves also. So in general, I think all of them will be performing similar lah. Whatever option you take, they're all pegging against each other, right? It's not really a way that they make a lot of money, but it's just more. I think it's a lot more about acquisition.
Yeah, client acquisition.
Just kind of keep you within the ecosystem. You become comfortable with us. Then upsell other things, right? In general, that's kind of what it is.
Yeah. So like for the Singlife, a lot of us actually went to the Singlife account earlier, like last year, because they offered quite a good return rate. And then, if I'm not mistaken, towards the end part of last year, they launched like a new product. I think it's an investment link kind of plan. They call it Grow. And obviously, if you already have a Singlife account, it's it's an easy way to just cross sell.
Yes. And that's the world turning into like the whole digital finance kind of where you see a lot of social media tech elements that have been used in a lot of other kind of consumption platforms, even in the digital finance world. Right. So I think listeners need to be a little bit more aware of these kind of things. Like companies are doing these things that it used to be okay because Lazada do it, right? And you're just buying things, it's fine. But now, financial companies are using a lot of these kind of like tech strategies.
Yeah.
Right. And I think people need to be very aware of.
I mean, another thing that I think is worth mentioning is that when there tends to be a significant difference between, let's say, the projected returns for cash management accounts offered by the different robo-advisors, there may be differences in the underlying funds and the risks that they pose. It might be a marginal difference, but that is what can result in that higher return that they offer to you.
Yeah. So definitely you need to understand what is the underlying instruments that they use, right? Don't just now, 1.5, you put 1.5 like that, right?
Yeah.
You want to know what's going on, right?
Yeah.
Yeah.
But in a general environment where interest rates are so low, right? How can I make more money?
So it's a spectrum.
Because it's going to stay like
Yeah.
that for a while, right? Based on
Yes,
what
correct.
we are projecting 2024.
Correct. So it's a spectrum. I think for many people here, I think goal-based investing has become a in thing, right?
Gold.
Goal-based
Gold.
investing.
Okay.
Yeah.
So I guess for your emergency funds, advisors will say, keep 6 to 9 to 12 months of your expenses as an emergency fund, and this can be deployed into, stuff that's a bit more liquid, very, very low risk, which is what we've been talking about. It could be your traditional bank savings account, your insurance savings accounts, and even some of the robo-advisor accounts. Even though those are actually, the cash management accounts actually are not principal protected, right? Still subject to market volatility,
Yes.
mark to market.
Would you guys consider government bonds as risk-free in that sense?
So the credit risk is very low,
Yes,
but it's
yes.
still subject to
There's still the secondary market.
interest rate risk.
Okay,
right?
interest rate.
So for example, let's talk about 10-year US Treasury bonds, right? Most people think of it as a risk-free asset.
Yeah.
But from, let's say, September, October last year, 10-year Treasury yields was at 0.6%. Now it's at 1.6%. So that 1% move in interest or in yields would have actually caused your 10-year Treasury bond to decline by, let's say, 5-6%. So actually for the first quarter of this year, the US 10-year Treasury bond market actually experienced the worst performance since 1980.
Wow.
Yeah, even though you consider it a risk-free asset.
So be cognizant about this thing, right?
Yes, correct.
Okay.
Yeah.
So then if I don't want to participate in the markets, I just want very legit risk-free.
Legit risk-free.
Yeah.
So
what are some ways that we
yeah.
can participate in?
So if you have a slightly longer time horizon, there will be some insurance companies that will market endowment policies, right? So I think one insurer that recently came to market was Great Eastern, right? They launched a 3-year endowment policy that offers a 1.55% per annum. 3 years.
Very short.
Yeah, so 1.55% return per annum and fully guaranteed as long as you hold it to maturity. If you actually went to get a 3-year fixed deposit from a bank, the return is only about 0.6%. So you're still seeing this. I wouldn't call 1.55% very high, but given that it's guaranteed on maturity, for cash that you don't really need in the short term, and yet you want some guarantee and you want a slightly higher yield, then endowment plans potentially could make sense.
Especially when they're shorter and shorter these days, right?
Yeah. So for endowment policies, they're marketed across a wide range. It could be as short as 1 year. Even for myself, my family, we have bought into 1-year policies last year. We wanted to park cash in a yielding account that's more than like 1%, so we actually had some policies just 1 year. But obviously, for endowment policies, they can stretch to as long as 40, 50 years.
Yes.
And it's really to cater to different goals that investors might have.
And that was actually the standards in the past. Endowment plans were very long, at least in the what is very prevalent in the market, right? Retail amongst the auntie uncles, it's everybody when they think of endowment plans, 30 years. It's nobody think of endowment plans as a 3-year, 1 year kind of thing, right?
And it used to be a very popular investment option, and it still is for a lot of people. So currently, I think there are 2.3 million endowment policies that have been incepted in Singapore.
Nice. Okay, just to give everyone a little bit of context, in the past, endowment plans were paying out a lot more interest.
Yes, but then
yes.
to be fair, they were paying out a lot more interest, but the interest rate was also much higher in general.
Yeah. So back then, during the high days of 12% interest rates,
Yeah.
right? But they were paying out at that kind of price, right? So,
Yeah.
but it's still pegged to the market
Yeah.
in essence, right? Pegged to the interest rates markets, right? Based on how it moves. But I think for a lot of people, when you hear your older generation saying endowment 很好嘛, right? Then don't flame them, because at that point in time, they were getting that kind of rates, and it's locked in, right? The rates are locked in. So over the extended period of time, they were getting that kind of very good rates relative to the market, right? But these days, things are different.
Yeah.
But I know you guys are doing the whole traded endowment thing, and you're not alone, right, in the market, right? I think Phillips Capital, they also do that, and a few other companies, they also do that. Not sponsored, so okay. Must say, not sponsored, but how does that then play out in this thing?
So the funny thing is, the reason we got into the space is because we actually wanted to buy these traded endowments as investors first, right? Because it was about 3 years ago, I was looking at the inventory for some of the brokers. They were offering about, let's say, 4 to 4.5% per annum projected returns for the investor for policies that were maturing in, let's say, 7 to 8 years' time. Right? So these are not the policies that are 30 years away, right? 7 to 8 years is still, I would say, relatively medium term. And to get a 4 to 4.5% projected return, to me, was pretty decent because 3 years ago, the interest rate environment was really very low, right? If you're buying to high yield bonds at that time, probably that's the kind of expected return that you're getting for yourself.
But the risk premium that you're paying,
the risk could be higher, right? Because you could be buying a high yield bond with a 5% yield to maturity.
Yeah.
But there's also an element of default risk,
Yes.
right? Because high yield bonds on average, I think default rate is something like 3+% per annum. So you are taking that kind of default risk. Personally, I was looking at something that I was looking for my parents, right? Because my dad's already 72 this year, and I wanted
Don't want anything exciting, for
I wanted
uncle
something to be a bit
72,
more
right?
conservative.
You want like confirm.
I wanted a bit more conservative. And 3 years ago, we really were in a bull market for 9 years, right? For stock market. So I was not very confident in also, putting a lump sum investment into the stock market. At least not for my parents, retirement money. Yeah, and that's how we actually came across the space. Yeah.
So how is it different then? Endowment versus traded endowment?
So the interesting thing about trade endowments is we would have bought it from the original policy owner, right? If the original policy owner wants to surrender his policy prior to maturity, most people would think that they only have one option, which is to surrender the policy back to the insurance company. But typically when they do that, the surrender value they get from the insurance company tends to be very, very poor.
Lowball, right?
Yeah, especially in the first few years. Let's say if it's less than halfway through the policy, they could have lost almost half of whatever they had invested in the policy. Yeah.
Yeah, but it's not necessarily because of any greed on the part of the insurance company. It just so happens that the insurance company has to pay for distribution costs or your agents.
Which means agents. Distribution
And
costs
so-
very, very sterile.
That's a very nice way you put it.
Yeah,
and so
yeah.
because of that, that's already a sunk cost for them, and they cannot give you back that amount. Yeah.
And actually, the
So
insurance
that's
company
why-
doesn't earn from the policy owner surrendering the policy, right? So if let's say the insurance company gives a poor value to that policy owner who surrendered, actually the other existing policy owners in that plan actually benefit in a way. So the intention of giving a poor surrender value
Is to
is to
discourage
actually
you.
to discourage you, because you're supposed to hold it to maturity and to protect the other policy owners who are currently invested in the same plan.
And to give everybody a little bit more context, insurance companies and insurance agencies and the retail guys are three different parties.
Yeah.
It's because a lot of people will say insurance company, but I think because we're talking about exactly the issuer of the product, we need to
Yeah.
be clear that the insurance company are the ones that issue the products. Your interaction as a retail individual tend to be with the agency. They are the ones that sell you. So that's the sunk cost
Yeah.
with the distributor, right?
Yeah.
Correct.
Okay. So then, in that sense, how does traded then work then?
Yeah.
Because they don't want to encourage you, then how does it work?
Yeah. So for the person who's thinking of surrendering his policy prior to maturity, right, he actually has a second option that many people don't really know about, which is he can actually sell this policy in the secondary market. So in Singapore, there are, I would say, maybe about 5 or high single-digit players who can actually purchase such policy. They do this as a business, right? And they offer the policy owner a value that's above the surrender value, right? Only then will it make sense for the person to then sell to these brokers.
Of course.
Yeah, so ourselves included, right? So when we first started buying these policies, we had obviously a dual mandate. One is our personal dual mandate.
Dual mandate.
You very corporate. Yeah. We got dual mandate. We write this in.
Yeah.
Okay, say. Yeah, I like the corporate.
Yeah, of
He
course.
don't worry, he reads finance news every day. So after a while, it just like seeps in.
Yeah.
Go ahead.
So for ourselves, obviously we got buying these policies as an investment for ourselves, right? So we have to hit a
Yeah.
minimum threshold to make sense for ourselves.
Yes.
But at the same time, our intention is not to lowball the policy owner who's surrendering the policy. Right? Typically, the person who's surrendering it is really not in a very good situation himself.
Of
That's why he's
course,
surrendering
of
it.
course.
Right? So we wanted to also bring in a social aspect to buying these policies. So far, based on what we have purchased, I think we've managed to offer about 25% above the surrender value.
25%, yeah.
Yeah, so I think that is something that I think is well above market at the moment compared to some of the other brokers.
Some of the other brokers they say on their websites that they offer 5 to 10% above the surrender value, just for context. Yeah.
So their margins are much thicker in that sense.
Much thicker because they know that, let's say the policy owner only knows about them as the only broker in the market, or thinks of them as the only broker in the market. Then, they just have the chance to lowball, right? Even if you give 2% higher than the surrender value, theoretically, like, you're still better than them going to the insurer, so they might as well just offer you as low as they can. But because
I guess it
we're
also
not...
depends on the company's competitive edge, what they're trying to achieve, right? So there are some companies which will try to have an edge in terms of marketing, right? So they'll go on the radio, post on newspapers, have a larger distribution network, but that also will feed into higher costs for the firm, right? So for ourselves, so I wouldn't say that they're offering a lower fee because they are getting a bigger profit. But I think it just depends on what business model you're trying to work with. At least for ourselves, we try to work with a model that is to keep costs as low as possible so that we can give a good price to the policy owner. But subsequently, when we buy it over, we'll also be looking for investors that we can sell it to, right?
Can you paint me a little bit of a picture? What is a typical endowment plan today looks like, right? Let's say there's a 30-year endowment plan. What is the kind of expected returns that I can get? And then versus a trader endowment that I kind of buy from somebody halfway, right? How does it look like?
So maybe I won't use a 30-year example because for trader endowments, typically we have bought it halfway into the life, right? So if it was a 30-year endowment, it would now probably be left with 15 years. So maybe use example of a 15-year new endowment. If you went to an insurance company today to buy a 15-year endowment plan, the expected return for the policy owner likely would be around, let's say, 3% per annum, right? When you look at the what you call the benefit illustration that's provided by the insurance company, a lot of them will show a base case of a 4.75% investment return. This rate is actually legislated by MAS. It's a relatively realistic rate of what the insurance company is able to achieve in terms of investment returns, right? But the policy owner doesn't get a 4.75% return because you need to minus off, like what we mentioned just now, the distribution costs, the cost of managing all these investments. So for the policy owner, typically he gets about 3% per annum. For a trader endowment, which is what many people refer to as a second-hand endowment policy, typically what we see in the market right now is that for a 15-year policy life to maturity, you can probably get about 4.5% per annum return.
Okay.
Right. So it is significantly more. You think from 3% to 4.5% is a 1.5% difference, but actually it's 50% more. Right.
So essentially, what I'm hearing is I am picking up something that is like someone already paid halfway already, right? They subscribe to this endowment plan and they've already paid halfway through. Something happened, they decided to drop it. So then when I buy it, I have to kind of pay up all the sums that they've already paid in some ways and to the individual that's trying to sell it, right? And in this process, they get back a little bit more, but then I kind of continue paying that premium. Is that kind of how it is?
So, like the reason why like what I mentioned, right, the yield can be a bit higher for a second-hand endowment is actually because for the investor, he might actually not pay what the original person paid.
Yeah, for sure, because we're basing off surrender value.
Yeah,
right?
basing on surrender value. So if you're paying less than what the guy has paid, that's why you're getting a higher yield. That could be one reason. The second reason is because that the policy has really, let's say it's been running for 15 years, right? The policy has had time to accumulate some sort of investment returns and declare annual bonus for these 15 years. This could be the other element that's driving the higher returns for the second-hand policy relative to a first-hand policy.
Okay, it sounds very pretty, right? And everything sounds pretty, Anna. It's like, what are some of the risk factors then? Investing.
In terms of some of the risk factors, let me first cover the risks which are similar to the risks of a newly incepted endowment policy.
Okay.
Right? So the first is if the underlying participating fund that the insurer holds performs badly, then there's a chance that they may not be able to pay out the maturity value that they had projected. Right? So this is a risk for a new policy, and it's also a risk that trader endowment policies will face.
It's the same, right?
Yeah, it's the same.
But then how do I evaluate the underlying fund then?
You generally will not have.
You don't know, right?
You wouldn't know about that.
It's just endowment. Essentially, you're trusting the insurer, and then they will take the money, and then they have their own investment mandate that they will do on their own, right? So you don't actually get to evaluate that.
You get to see the historical performance of these participating funds across the insurance companies. So, for the astute like investor, some of them might want to avoid certain insurance companies because they might feel that, historically, the performance of their funds hasn't met up to the 4.75% projection, right? If you look at, let's say, the last 10 years, for example, right? So there are ways to, differentiate across the insurers marginally. And the other second way is also to look at the asset allocation in the participating fund, right? Some insurers, if the stock market did really well this year and you see that their asset allocation was more tilted towards the equities, potentially you know that this year this insurance company is probably going to do a bit better.
But are you going to be getting more?
Sorry?
If they perform better?
Yes, so actually the projected maturity value can be revised upwards as well. So I've seen such instances. But I would say that over the longer term, like the last 10 years, it is more likely that they revise down just because the interest rate environment has been going a bit lower.
Okay. That's cool.
So for traded endowment policies, they'll be sold by a second-hand policy broker, right?
Which you guys are one of them.
Correct.
Yes.
So when you're buying from a second-hand policy broker, we are not financial advisors, right? So I'm not going to be able to tell you, based on your financial goals, you should be buying this, and this, or this how you should be looking about your portfolio holistically.
Essentially selling a product, right?
Correct. We're just a broker, so you would have to have had a think about what your financial goals are and how you're going to achieve them on your personal basis, and potentially you have really asked your financial consultant, right? You shouldn't rely on the broker to give you advice like this. A second risk that you will face when you're dealing with a second-hand broker is that for traded endowment policies, they are not an asset class that's regulated by MAS. So
Yet.
it means, yet. So
what is always
Yeah,
I think
correct.
it's still, the space is still too small, so it's unlikely that MAS will come into.
I know in the
regulate.
UK they already have structured products around
Yeah.
trader endowment. So
So in fact, in the UK, in Australia, there are mutual funds that actually hold traded endowments,
Yeah.
right? And because you know that I mentioned they're yielding 4.5%.
Yes.
So these mutual funds are able to distribute this 4.5% as income, right? So it's almost like a income fund.
yeah, exactly,
Yeah.
right?
Yeah.
And it's diversified across insurers,
Yes.
diversified across
Yes, risk
different
managed
maturity
in that
years.
sense.
Yeah. So just now what I mentioned is that this space is not currently regulated by MES. So if you do purchase a policy, it's a bit like going to Carousel and buying an item there, right?
I don't know how I feel about that. I don't know how I feel about that. Like, it's like you're buying a financial product. It's like going carousel like that, right? It's like
Yeah, so that is a risk. That is a risk that the investor has to take. So if anything goes wrong, you shouldn't be approaching MES for it because it's not a regulated space by MES. What you can do is you can go to the Consumer Protection Act instead. Yeah.
look for case, huh?
Go
Everything look
for
for
a
case. Yeah. So,
Yeah, which makes sense. I mean, that makes it even more important to kind of do your due diligence on the different brokers and see which one gives you more disclosures, etc.
So
Yeah.
fundamentally, you're reliant on the trust with the broker.
Trust with the broker as well as yourself. They have to. I mean, you have to educate yourself on what the product is, right? Because if you don't know enough about the product, it'll be difficult to know what people are not telling you. Yeah.
So one way to get around this issue also is to conduct the transaction, which is what we always do. We always conduct the transaction at the insurance company's office, so that when we go through the terms of the policy, it will not be me telling you what the policy terms are. I would have already told you earlier, but you can then clarify and confirm everything with an independent, customer service staff at the insurance company, right? And I think in that way, the risk for you will then be much more mitigated.
Okay, at least you get clarity of what does this particular policy covers, and all the interesting things inside a structured product essentially. Okay, that's cool. So are you seeing more and more people pick up on this idea, and how does it then sit into people's broader financial plan? Because exactly like what you point out, right? Yeah, in the UK it's becoming like an income fund.
Yeah.
So although I know you cannot give exactly like how to do it, right? But it's just more like where do you think people can adopt trader endowment, as part of their portfolio?
So for me, the trader endowment space would cater for people who have specific goals at certain parts of their life.
That's the beauty about
So-
endowments, right? Because
Correct.
it's it's essentially I give you money, and then you give me a fixed return. It's like a trust-based thing, limited market movements in that sense.
So for some goals that you have, it might not be compromisable for you. For example, you just gave birth to a child, and you know that in 18 years' time he's going to college, right? So you know that his college education, the fees
I
to
scared
you,
for your kid.
it's not compromisable,
It's
right?
not compromisable. You must go uni.
You need to have a guaranteed amount of money at that point of time.
Yes,
And
yes.
obviously, a lot of people, they know 18 years is quite far away, then they invest in the stock market. But, just if you are very sway, and during that year there's a downturn and you're down 30%, do you really want to be liquidating your portfolio at that point of time to pay for a school fee? Probably that might not be the best option. So for endowment policy, or for the traded endowment policy also, there are two elements to it, right? There's a guaranteed component at maturity, and there's a non-guaranteed component. So at the very least, if you're buying a policy that's 18 years away, you can see that minimally, if the insurance company declares zero bonus every year for the next 18 years, the maturity bonus is zero, you know there's still this guaranteed amount, which is obviously the most unlikely of scenarios, but at least you're secure that there's enough for your child to go to college, right?
Okay.
So
that
it makes sense for those who are already considering endowment plans, but they want a yield pickup, right?
Yeah.
So then they see that, how come traded endowment policies are offering better yields and potentially for shorter amounts of time? That is what makes it attractive to investors.
But of course, there's two downside risks that the investors will take note of. Because there's always a good part, there's always the bad part also, right?
Yeah.
people always like to talk about the good part. Yes.
Yeah. So the bad part is, if you are buying it for the insurance component, the traded endowment doesn't give the investor insurance coverage on his life. The insurance coverage is still on the original life assured, right? So theoretically, if the original life assured, let's say if he passes on, the investor actually can claim the death benefit from the policy, and typically that will be a favorable kind of thing for the new investor. But because they won't be in contact with each other, this will not likely be the case. You don't know the person, you won't be getting his death certificate. Typically, we just ignore the insurance component. This is something that the investor will not likely be getting, right? A second downside is that for policy, you know that you're supposed to hold to maturity, right? It's an illiquid vehicle. So when you think about, let's say, the 07-08 crisis, right? There were quite a number of mutual funds that were holding these traded endowment policies at the time. And during that period of time, obviously, a lot of people get very panicky, right? Everybody starts to sell the mutual funds at the same time. But if the underlying asset is illiquid, it just doesn't, work.
Drop
right?
it off, right?
So this should be something that you're saving up to a particular date, not something that you're looking to sell again in like the next 1-2 years.
Essentially the boring vehicle, right?
Yeah.
Not the exciting thing.
Yeah.
And you probably should have a plan for it in
Correct.
that sense.
Yeah.
Okay. Essentially, people will explore a tool like that on their search for income, right? To try to achieve a certain goal and have that kind of consistency, and make a better yield than, what is the current interest market out there, right? But what are some other tools that people can explore then, in your view?
I think it's possible to explore CPF Chopups, right? If you top up to your MediSave account
The
or
one
your special...
M65 movement, is it?
Yeah, the 1M65 movement. Yeah. If you top up to either your MediSave account or your special account, you can earn 4% per annum, right? The downside to that is that obviously if you're a young person, you cannot withdraw the money anytime you want, right? Because it's a long-term savings account.
Yes.
But yeah, I think that's one major way that people can look to increase the yield on their cash. Peter, can you think of other ways?
Yeah, so obviously Singapore has been encouraging people to top up their CPF, and there are obviously certain schemes where you can get tax deductions on your top-ups as well.
Yeah.
So let's say if now you're 45 years old already, and you know that you can withdraw your some part of your CPF when you're 55, and you are currently having a marginal tax rate of, let's say, 10%, right? So if you are getting a 10% tax deduction on your contribution to the CPF, and you spread it over this 10-year period, actually you're getting almost 1% extra yield a year, right? So actually you're not getting 4%, you're actually potentially getting almost a 5% type of return in that sense.
Yes.
So I think that is something, to me, I think it's every Singaporean has CPF, right? So it's something that I personally do every year, topping up my SA account, topping up my MediSave account. Yeah.
Okay. I think that's cool. But I think for everybody they need to be very very aware, right? This is a one-way track, huh?
Yeah, correct.
Nothing's gonna come out until you reach that retirement age, right?
I think our most popular article today is our CPF article, right,
Yeah.
Peter? Yeah, 5 ways to optimize your
CPF.
Yeah.
And those kind of articles tend to be very popular, right? In the sense of like, 5 ways to do something, 10 things you need to blah blah blah, very listicles. And as long as you're comprehensive, it gets shared very well.
Yeah.
Right. So that's definitely part of it. But of course, I think people have to also be aware, of like minimum sum, all those kind of things, CPF Life. It's all part of a thing, right? Because it's the whole vehicle. Don't just look at it from one component,
Angle,
right?
yes.
Yeah. So you got to look at the whole vehicle before you put money in.
Yeah.
Generally that's kind of my take, lah. But what about like entering like what we talk about, like high yield bonds or like Chinese bonds? Those are like increasingly there's a lot of discussion over there. So what is your take?
So if you look at the high yield bond space, let's say you just take a look at, let's say, US high yield bonds. Typically, you'll see them yielding about 4.5%, maybe 5% yield to maturity. And for many investors, that might sound like quite a high, attractive level for them. But one thing that they need to note is they have to factor in the expected default losses for high yield, especially for high yield bonds, right? So, for example, the average default rate for US high yield bonds has been about 3+% across the economic cycle. And for a defaulted high yield bond, the recovery value is typically about 20 to 30 cents on the dollar, right? So what that means is that you should be factoring in around 2, maybe 2.5% of expected credit losses every year from whatever high yield bond portfolio they have. So if you're getting a 4.5% yield to maturity, if you minus off 2 or 2.5% in expected default losses, actually your expected return is only going to be about 2.5%, which is, in my view, not very exciting, right? The high yield bond market now is definitely not cheap. I think there are certain parts of the high yield market which offers relatively better relative value. So, for example, if you look at the Asian US dollar high yield space, the credit spreads over here are slightly wider. If you look at the yield to maturity of the Asian high yield bonds, you can still get about 7% kind of yield to maturity. And historically, actually, even though people think that Asia is like emerging markets, but default rates are quite similar to that as the US high yield bonds, right? So if you're getting 7% and unless you minus about 3% of expected default losses a year, you are at least getting this expected 4% return. So in that case, it's still not too bad. And if you look at the high yield bond market within Asia, it still hasn't recovered back to pre-COVID levels. Whereas for the US side, it recovered really quickly and it's really way past the pre-COVID levels. Yeah.
Okay, give us a little bit more clarity in the sense of like default rates, right? So what I'm hearing is, if the whole fund has like $100 million and it yields at 4%, but the whole $100 million will generally lose about 3% of its capital every year, essentially, because of defaults.
Yeah.
Right. Is that what
that's
I'm
what I'm
hearing?
saying. Yeah, that's what I'm saying.
So
correct.
you factor that 3% loss, into the whole portfolio, which you are part of it. You're a fractional owner of the whole portfolio.
Correct.
So then net maybe 2-3%.
Yeah.
But if you go to the Asian market, which is currently still giving at about 6 to 7%, you factor that 2-3% loss, you still have about 4-5%.
You have a bit more buffer in that sense.
A bit more buffer. Okay.
And actually, if you have the view that credit spreads start to tighten, you actually might get additional capital appreciation as well, on top of the existing yield that you're getting on the Asian high yield bonds.
Because the bond market have not recovered yet.
Has not fully recovered
yet. So then there's still that squeeze that can come in.
Correct.
Wow, we're going very technical, huh?
Yeah. Of course, just now, earlier in the podcast, we were talking about two aspects of two factors that drive fixed income markets. One was interest rates, one was on credit spreads. So this we are talking about the second element, credit spreads. Yeah.
Can you paint me a little bit a clearer picture, like how does that work?
Okay, so for example, if just to explain what a credit spread is.
Yes.
So for example, if let's say you have a US Treasury bond, let's say currently the yield is 1% per annum, right? That's the risk-free rate. If you're buying into a corporate bond in the US and let's say it's yielding 3% per annum, the credit spread is this excess compensation you're getting for buying and taking this credit risk. So the credit spread will be 2% in that case. So when we look at the US high yield bond market, over the last 15 years, the average credit spread level has been about 5.5%, and currently it's about 3.6%. So the current level is quite near the lows of the last 15 years, right? So you're not really getting in at a great time,
You're
but
not
obviously
paying
because you're not getting
the-
bang for your buck.
Yeah,
But at
yeah.
the same time, because we are also on an economic recovery, so everyone has priced this in.
Okay. So then in Asia, people have not priced it in.
Correct.
So that's the
Correct.
beauty
So-
of the spread.
Yeah, so in Asia, let's say if you look at the last 10 years, the average credit spread for hard currency high yield bonds here has also been around, let's say 5.5%. But now the credit spreads in Asia is 6.3%, right? So it hasn't even recovered back to the historical average yet.
Is there a reason why? Try
So,
to help us understand. I know
a
correlation is
large
not causation. We're not trying to
Correct.
predict, like why exactly, but just kind of give us some color, so that our listeners can get a clearer
Yeah.
understanding.
So I can think of two big reasons, right? One is last year, obviously in the US, they announced a lot of, they supported the bond market by purchasing not only government securities, but they also supported it by buying investment grade bonds and even high yield bonds, right? These were all bought by the Federal Reserve.
Yeah,
right.
they were just buying.
Correct, just buying. So obviously this also drives higher the price of high yield bonds over there, drives down the credit spreads. But in Asia, we don't really have this equivalent artificial buyer in the market, right? And for the second reason why the Asian market hasn't recovered fully is because a large part of the Asian high yield bond market is actually comprised of China property bonds, right? And recently in the space, the Chinese government is trying to clamp down on debt levels over there. They're warning about potential bubble in the Chinese market. And this will result in these Chinese property developers finding a tougher time to refinance their bonds. And if that's the case, there will also be a slightly higher risk of default, right? Because you can't refinance your bond, how are you going to start repaying the bonds that you already previously borrowed on?
So then they'll pay you more
Correct.
to get that premium so that they can continue to kick the
Yeah.
can down and
Yeah.
keep rolling,
Yeah.
rolling. Okay. So then, are there tools in terms of very specific to the Chinese bond markets?
So I think for bonds, obviously you can buy directly, but because for most bonds they're traded in denominations of USD 200K or Sing dollars 250K, these are meant more for high net worth investors in Singapore.
Yes.
If
For
let's
the
say
lay guy, for all of us.
for and actually even if you're a high net worth investor and you have like let's say 10
you
million,
don't want to concentrate, right? On
you shouldn't be putting 2.5% of your cash in a single bond issuer also anyways, right? So the alternative is you can go through more diversified vehicles. So one way is ETFs and the other way is mutual funds. For ETFs within, let's say, the local market listed on SGX, there are ETFs that trade China government bonds. So that is to me, is much safer. That's yielding, let's say, about low 3% per annum, which I think is still pretty decent.
Do you consider that risk-free? Because the
So-
government is the issuer, right?
Correct. So you have to look at the credit rating of the government also. So for the China's government rating, it's rated A by S&P, which is the same as Japan, right? So I would say it's fairly safe, right? To be rated the same as Japan is fairly safe. But the thing that people need to note about investing in Chinese government bonds, especially the government bond ETF that's listed on SGX, is that the underlying bonds are traded in renminbi. So you are also taking this additional currency
Exchange.
risk, even though when we trade on SGX, it's traded in, let's say, Sing dollars. Yeah. But it could be a double-edged sword, because if you are bullish about the renminbi in the next 2-3 years, that
You
could be
think
another
China will take
driver.
over
It
the
will be a
world,
driver of
right?
returns for
Yes.
you also as it continues to appreciate.
Yes.
Yeah.
So that's the thing with a lot of products out there, right? It's like
Yeah.
you think it's a certain thing, like you're trading on SGX, you're using the Sing dollar, but underlying tool is China, and then it still trades in RMB. So that multi-tiers, I think people need to be a lot more aware,
Yeah.
of these kind of
Yeah.
things.
There's also a Asian high yield bond ETF that's traded on SGX. I think it's issued by BlackRock or iShares. But the problem with it is that it's not very liquid. So if it's not very liquid, what happens is that there tends to be a slightly wider bid-ask spread. Right? When you trade stocks, sometimes if you're buying a stock that's $10, you see that the bid price $10, the ask price is $10.01. But if there is not enough liquidity, instead of $10.10, it will become $10.10 maybe. So that is a cost that many people might not factor in.
So one last question for both of you. I think we've explored all these different tools, from like trader endowment to like high yield bonds to cash management apps, even CPF. Well, CPF 都跑出来, right?
Yeah.
everything it's part of this thing, right? So I just want to give our audience a little bit hypothetical, right? So if someone is just kind of just starting out, making money, a little bit into their career, about 30 years or 35, have some sort of money sitting around, how will you then, but they don't want to be too exciting in the stock market, because I think a lot of people are I think there are a lot of people that are risk averse. Of course, we can talk about the historical yield and all those kind of things, that why you should have some sort of portfolio in equity, but if let's say they don't want to be in equity, how do you think they should structure their portfolio then amidst all these different tools?
I think it always goes back to your goal-based investing, right?
I was going to mention that.
So your 6 to 12 month kind of savings, I'll put it, the stuff that you actually need for day-to-day expenses definitely has to be in your bank, your traditional bank account. Anything else, let's
Maybe
say
in the future it can be a digital bank account, right?
Yeah, maybe it'll be a digital bank account.
Yes.
Yeah. Then maybe for the additional, let's say 3 months of your savings in your traditional bank account. Additional 6 months could be in something that's a bit higher yielding, right? It could be your cash management accounts by the robo-advisors, or the insurance savings accounts, right? For your next chunk of your cash that is for your medium-term goals, stuff that you need in your next 2 to 3 years, it needs to be in a relatively conservative type of investment. Then you can consider maybe potentially endowment plans, right? Because that comes with a there's a guaranteed component to it already. And you can customize it to meet your goal that's happening in like 3-4 years' time. For anything that's more than that, if you want something that's a bit less risky, I still think stocks are a good long-term investment. Anything that's more than like 10 years. I'm just citing an example, right? If you had a 10-year investment period and you invested any time between the year 2000 and 2020, right, you have gotten at least a 3% or higher return per annum if you had looked at the MSCI All Country World Index. Obviously, this is backward looking, right?
Of
So
course,
we can't
of course.
really foresee the future.
Yeah.
But just a really broadly diversified ETF, right? One more tilted towards the developed world, and then one for emerging markets. If it's really well diversified and you're willing to hold that for a long period of time, I think investing in stocks is actually not as crazy or as exciting as a lot of people make it out to be. Yeah. It
Nice.
generally is more difficult to look at bonds
It is.
because they tend to be a little bit more difficult for the person on the street to understand. Yeah.
And I think for the bond market now, like just now you mentioned, right, the short-term yields are low already. But at the same time, we still expect the long-term yields to rise. So if you're entering the market at this point of time, you're actually faced with a very big
lose-lose
dilemma,
situation,
lose-lose. And on top of that, just now we mentioned that credit spreads are really very tight. So if you invested in a bond that's maturing in 10 years' time, you lose out from interest rates potentially rising. You lose out from potentially credit spreads widening also. And that will impact the value of your corporate bond.
Fair. So
Yeah.
either way, I think all in all, the idea is don't be afraid of the stock market, right?
Yeah, don't be afraid of the stock market.
Don't be afraid of the stock
Yeah.
market. Be broadly diversified,
Yeah.
and if you have some other things that you need, other goals, then you can explore all these other tools that we have discussed today.
Yeah.
I mean, if they do select single stocks, I think that's where more of the risk can come from.
Yeah.
So if I put 20% of my portfolio in Tesla, right?
all that exciting, huh?
Yeah, super exciting. Then that's where you might get a significant dent in your portfolio if one stock crashes,
yes.
right?
Single stock risk concentration.
But I think I still think that bonds are okay, but it really depends on the investor, right? Like
course.
let's say recently, Singapore we had an Astria bond that was issued, strong subscription, and it's kind of like it's a 10-year bond, but there's a mandatory call at 5-year mark. And if you know that you're not going to use this money for the next 5 to 10 years, then you are able to weather out this mark-to-market and
Yes.
volatility of the market in the next 2 to 3 years potentially.
Yes.
Yeah.
I fully understand what you're saying. Actually, historical bond returns are actually very healthy also.
Yeah.
Not 10 years, but you extend 100 years, actually it performs very well also. But the problem is, like what you two have pointed out, it's not easy to understand, right?
Yeah.
There are more moving parts in this thing, and we can always have another conversation, sometime down the road. Thank you.
Yeah.
Thanks for coming
Okay,
on.
thank
Appreciate
you.
it. Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, sign up for our members backend for more investment-related content, live discussions, curated content, and most importantly, your commitment to us is a step forward for us to continue creating great content focused on you rather than advertisers. For more information, check out thefinancialcoconut.com. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Okay, I have last 3 questions for both of you.
Okay.
We ask every single guest. Okay, and the first one is, what is a core life principle that you hold close to?
Okay, so I'll take that one. It's not a principle per se, but we like to think about this concept called Ikigai. There's Ikigai. I see you nodding. Do you know about it?
I just finished reading Wabi Sabi.
Oh, really?
Yeah,
Okay,
yeah, we might be here.
Very good. So for the listeners, basically this is a Japanese concept that outlines 4 objectives that people can have in life, right? Doing what you love, doing what you're good at, doing what the world needs, and very importantly, doing what you can be paid for, right? So whatever career you end up choosing, I think Peter and I have observed that, there generally just tends to be an imbalance between the 4. Maybe you don't feel like you're earning enough, or maybe you don't feel that there's enough meaning in your work or whatnot. And there are 2 ways to compensate for it. So the first way is to work within the framework, right? You could, let's say if you don't think your job is super meaningful, you can do pro bono on the side. Or let's say you think your 9-to-5 job is not earning you enough cash for some reason, you can try to earn money elsewhere, right? But the second way is to work outside of the framework, and that is usually it means setting up your own business or your own enterprise. And so for Peter and I, that's what we have done with respect to the InvestQuest and with Endowment Exchange. As Peter mentioned earlier, for Endowment Exchange, it was really important for us to have that social element to it. And for InvestQuest, we really wanted the flexibility to explore what we were interested in intellectually. Yeah, having that freedom.
Nice. Yeah. Okay. So next question. Okay, what is a personal finance advice that you feel needs to be further propagated?
Something that's more applicable to young adults, which is your personal net worth is actually comprised of 2 aspects. One aspect is your financial assets, right? So your cash, your stocks, your bonds. The second aspect, which is commonly overlooked, is your human capital. In financial terms, that's actually your present value of your future earnings. And as a young person, bulk of your personal net worth is actually in your human capital, right? So you need to get this right first. And that would mean even as as growing up in secondary school, you should already be getting some sort of career advice, right? And with that, hopefully you can then, build up the correct educational background, the correct skill sets, and also pursue something that eventually, you are also personally interested in. And hopefully that also works out in your favor, which brings you a good career, rewards you financially, and also something that you find like purposeful at the end of the day. Yeah.
I'm getting very concerned for your future kid. Secondary school must have career advice already.
Peter will be the more chill one. I think I will be a tiger parent. Yeah.
Okay. Well, we'll see. Okay. Yeah. So last question. So, what is your current life focus? What are you focusing on? Giving additional focus on.
So I will quote what Jack Ma said before. He said that when you are in your 20s to 30s, you should find a good boss, work for a good company, and learn to do things in the correct way. When you are between 30 to 40 years old, you have more room to explore, right? Even if you fail, it's still okay at that point of time. When you are 40 to 50 years old, that's when you should be focusing on doing what you do best, right? It's a bit more risky at that point to start to explore new ventures already. And when you are 50 to 60 years old, take the time to then nurture the new generation and provide these mentorship opportunities. And once you're past 60, you need to spend more time with your grandchildren. So currently for for Deborah and myself.
You don't need to spend time with your children, right, in any of those decades.
Yeah. So where we fit in would be the 30 to 40-year-old age range, right? Which means that we have time to explore new ventures, which is what we're doing with the InvestQuest, what we're doing with Endowment Exchange. But at the same time, we also think that nurturing ourselves and developing ourselves, both on a personal basis and on a professional basis, I think that's something that we have been trying to do. I think at least we have been a bit late to the game with regards to, let's say, crypto assets, with regards to computer programming. But I think it's better late than never. So I think that's what we aim to learn next.
Nice. Thank you. Thanks for coming on. I appreciate.
Okay.
You're welcome.
Thank you so much, Reddy.
Thanks for having us.
Yeah.